Because this is Gino Live every day. We do an hour of the market. We break things down, top-down approach. But we like to kick off the show with the fast 5 picks. This is what's showing dojis this morning in the green. And have a nice setup. Are they risk-worthy? And then down here, we got a few bears. There's more, but I just want to see what your guys' thoughts are on these. So what's nice about the fast 5 is there's still enough time today to trigger on these and maybe take a little profit. But if you're up the first hour like we did in New York last week, it was amazing how we did the dojis the night before and played that first hour. Did you notice most of the profit kicked in the first 45 minutes? And you want to hit target 1, move your stop loss to break even. That's a great system. I mean, if you could get up early enough, catch the trigger, move your stop loss to break even or a trailing stop, it was quite successful. We had 11 out of 15 that triggered that actually showed profit. Good segue here is this. Why do we look for stocks anyway when you can just trade the markets? I mean, stocks go bankrupt. They have earnings. They're more volatile. Oh, they're more volatile. That's why we trade stocks. Because the market is never the biggest mover. It never is. You see, the market is the average of all the stocks. But what we found is inside the sectors, the stocks in the sectors, some sectors move as a group. In fact, all the stocks in the sector, most of them, if not all of them, peak and valley at the same time. So they follow each other. Money moves into sectors. Most of the time, it's sectors moving, not just a stock. Sectors are more volatile than the market. Therefore, when the market's up, there's always a sector that's higher. And when the market's down, there's always a sector that's lower, meaning outperforming it. So once you focus on outperforming the market and you get that down, you start realizing all you have to do is focus on sectors. And then when you get good at sectors and realize the sector's never the highest, it's the average of the stocks, then you find out what outperforms a sector. It's the stocks in them. So how do you catch the run on the stock to get a home run and the big moves? The setup, the doji. And what's the easiest way to see the red light, green light? Using the payday cycle Heikin-Ashi MACD combination and tie that together with a bunch of my trading gems, like throwing the 20-day moving average on there, risk management, and you have it. So putting this system together, brand new people, TSR, you want to go with the trend of everything. That's the trend. We look for that setup, which is a doji, and we manage our risk on that candle. And then from there, you decide on the next letter, which is strategy. What strategy you're going to do? That's where you spend your time. So here is a Gino trading gem, a secret to trading. What's more important, target 1 or target 2? Here's target 1. And I say this after a few years of experience of doing these. Yes, target 1 is the most important. Why? Because remember the movie Moneyball, the baseball movie? They found out that getting to first base is more important than hitting home runs. Why? Because the more base hits you get, they all add up and start pushing the runs in. In trading, if I can put a trigger here, that's not quite target 1, right? But if I put a trigger here, look at this. So really, here's my stop loss. There's target 1. Why is target 1 so important? Because it's not about the profit. It's about once you hit target 1, there's no excuse not to bring your break even, your stop loss to break even. And if you hit target 1, there's no reason not to move your stop loss to break even. And now it's a risk-free trade. A risk-free trade means you can now start taking target 1 off, and target 2 is definitely a home run. The most important first step you need to do is get your risk managed to get the stop loss there. So there you go. That is the trigger. Okay, where do you like the trigger? Above today's doji or above the little breakout candles here? Do you see the shoulder, the upside down head, the shoulder? It's also a bullish triangle. Yeah, AU triple bottom, Nancel, is very important, but if it breaks a triple bottom breakdown based on the stats by some college, a triple bottom breakdown has the most consistent and successful profit to the downside versus a triple top breakout hits 5%, a triple bottom, I forgot the numbers, hits like 7% more often. It makes a bigger move more often than the bullish side. A triple bottom is more successful than a double bottom. And a double bottom is more successful than a single bottom. So a triple bottom breakdown is your best trigger based on all stock patterns. The more bottoms, you guys, the better the trigger when it breaks. If you buy going up, who's buying there? People that can put a floor in there. The Warren Buffetts. They buy this and it makes it go up. It comes down here, it tests the floor and it goes up. See how many times that? Guess where the stop loss? It's obvious. The more bottoms it has, the more buyers it has putting a floor in, meaning the more triggers for stops. So when those stops trigger, boom, self-fulfilled short. You're getting a market dynamic of where do you think all the stop losses would be on this chart? Right here. So that's a long squeeze. The exact opposite, if you have a lot of stops up here, that's called a short squeeze. Where the short people are getting squeezed out, they have to buy. That's why I like to be below that, right? I like to be below that trigger. So even right here might be good. But I'm hoping to catch the candle here, and this is target 1. We put target 1 in there, right there. Now check this out. We're going to go through market sector stock and we'll look at some more trades. When you're in SPY, look at the top holdings. NVIDIA 7.6%, Apple 6.8, Microsoft 4.4. Then you could click equal weighted. So I want to bring another little feature. When you're in something that's market cap weighted, it'll tell you if there's an equal weight alternative. So when you're looking at the SPY, you go, well, you know what? That's dominated by these guys. There's 5 stocks here, guys. 8, 15, 19, 23, 25% of this chart right here is these 5 stocks. How many stocks are in the S&P 500? It's not a trick question. 500. Actually, it's a little bit more. But think about this. 5 represent 25%. The other 495 represent the other 75%. Isn't that ridiculous? So this is going to bleed in as a lead weight into what I wanted to show you. When you go into the fundamentals of a sector and you go to overview, let's look at the spiders breakdown. It's bullish. RSI is 55. MACD is above the weekly. It's green right here, bullish. Broad participation, 5 of 5. 18 bullish setups ready inside. So if these are green and it favors the bull, we're going to give you bullish setups. Right here, you got the equal weighted equivalent. So when I click this, watch what happens. It's also bullish, RSI, MACD, broad part 17, basically the same setups. Okay, these are dojis. So you see how it's helpful to go back and forth to make sure the cap weighted, it's cap weighted, and the equal weighted move hand in hand. Do you see the power of that? Internals of the ETF. Now, ready for this one? Okay, this one is, this is a smooth, equal weighted right here. When I go to the MA20, you see how they're moving? This is narrow and building, broad building. When I go like this, you see that line? It's narrow and fading. Wherever the dot is on them, that's where it is. So you can see, like if I go here to, trying to get this without the, let me get right there. You can see it's come out of broad and building down to fading. This is the 14-day trail. Like here's the 50-day moving average. This is bearish. Where are they all at? You want bullish to circle up in here. I'm trying to find a good one here. Like, do you see all the, everything's moving this way? When it moves this way here, guys, bearish. When it starts building, it's going to move to the blue. When it's green, that is what? Bullish. So we're down here. The RSI, you can see the RSI, you can see that circle. It went this way. So let's go look at, for example, healthcare. Healthcare is right here. Looks very bullish. Is it building up strength? It's blowing away the S&P. See, it's on the MA20, it's blowing it away, right? Bullish, broad, two bull setups. And who's your bull setups in down here? You've got CVS and the other one, okay? How awesome is this internals, guys? SMH, we did right there. How awesome is, yet the rotation is always clockwise. You got it. So narrow and building, broad-based building, fading, narrow and fading. See that? So right here, semiconductors might be moving into it. And once again, semiconductors moves before technology. And that's why it's critical. Discretionary. Discretionary has 50 holdings, quite a bit. Mixed. We got some, look at this, because Amazon's like half of this ETF, right? What is Amazon? Amazon is 22.5%. Tesla's 18%. Look at that. The top three are half of the ETF. And there you go. It looks like that move. Look at, see how that spiraled into that? That's what you want. That is the RSI right there. MACD is spiraling into there. The 200 is almost there. The 50 is there. You know what? Discretionary is actually, you guys, discretionary. If this breaks above here tomorrow, let's go look at the internals here. I'm going to have to throw that to green. So believe it or not, this thing's not doing anything here, but the internals are telling me it's going to spring out. You see how we got the edge on the market with these? Okay. If there's any ever a day to send the tech team a thank you, this is the day.